techniques that can be used for valuing a business. Now, there are multiple ways that a business can be valued, but in essence, there's sort of four main techniques that are used for private businesses. The first one is, I guess, what we call market value, willing buyer and willing seller. This is normally used in sort of the listed space. So if you go to the JSE and you look for the price of a business, the market kind of decides what the going price for a business is, or what the share price is. And that's less likely in a private business where, buyers and sellers are not as readily available. So there's three main techniques. The first one is what we call, or shortened to DCF, or discounted cash flow. We then get the earnings multiple, or EM, or sometimes known as a price earnings ratio method, and the net asset value method. These are the three most common techniques in valuing a business. A discounted cash flow simply says, what is your current profit? What do you expect that profit to be into the future? And at what rate do you discount that back at? A discount rate is really just a measure of the risk ascribed to your business, and also the economic fundamentals. So if you're operating in a country with very high inflation, for argument's sake, that discount rate would be higher. The higher the discount rate, often, the lower the value of the business, because it means that 100 Rand or $100 worth of profit in the future is actually worth less than it is now. So the higher the discount rate, just remember this, the higher the risk, and generally the lower the value of the business. Okay. So that's a discounted cash flow methodology. It looks at what are your cash flows, what are your cash profits over time, and if you discount them back to today's Rand or dollar value, you add them all up, it's the value of your business. The second is the earnings multiple. What that looks at is it looks at your current earnings in the business, or your profit before tax. There's different metrics that some people use. Sometimes they use something called an EBITDA, which is profit before tax, depreciation, and interest. And that just really values what's the operating profit of a business. And the multiple is then, what do similar businesses of a similar size trade at? So you'll apply a multiple of 3 or 4 or 5, or maybe if you're lucky 6 times onto your earnings, and that will give you an approximation of the value of your business. One of the challenges with this is you're kind of comparing to similar businesses. It doesn't take the unique aspects of your business into account, doesn't take into account the risk inherent in your business, but it gives you a fair benchmark of what similar businesses in similar industries are trading at. And the last method is the net asset value method, which looks at the value of all your assets, so your property, your plant, your equipment, your cash, and it subtracts from any liabilities that you might have. So what do you owe your creditors, any loans that you might have to pay off, and essentially looks at the difference. And the net asset value typically would be used if a business that's not making any money might be better off actually selling the assets and starting something new. Often gets used in a liquidation scenario when a business has to shut down. The assets are auctioned off, the debts are paid off, and if there's anything left over, that goes to the owner. So those are sort of, let's call it 4 methods. The first one, the market value, which you often see for listed investments, the DCF or discounted cash flow, the earnings multiple, and the net asset value method.